Hi, I'm George Nordhaus, and we have a very unusual Monday morning today. It's by McKinsey and Company. McKinsey and Company is the world's largest management consulting firm. 2/3 of Fortune 1000 companies use their service. They're pretty amazing. This report was done by professional researchers, not agents, not company people, not even insurance consultants. I believe it's the most meaningful work on the future of our industry I have ever seen. The first part of it is all about the rationale. Why are they doing, or why are they saying what they're saying? Well, let's talk about that. You see, the local agents have long been an integral part of the property and casualty insurance landscape and continue to serve an important role as advisors and intermediaries. However, there's been a gradual shift in the value that carriers and customers, retail, small business, and so forth, place on many activities traditionally performed by local agents, which increasingly calls into question what role they will play in the future. Where agents once served as a front line in risk selection and pricing, advances in predictive models are making this role obsolete. The agent was once the face of the insurance brand. Now, consumers or customers increasingly use multiple channels to connect with their carrier. Perhaps most disruptive of the traditional agency value model, auto insurance accounts for 70% of personal lines premium, is fast becoming commoditized. Well, surprisingly, those trends have not yet led to significant change in the local insurance agency landscape. There are signs now, however, McKinsey says, that the economics of the traditional agency model are beginning to unravel. Carriers are more interactive directly with customers at lower cost and more consistent service levels than ever before. The once clear division of labor between carrier and agent is diminishing, but agent commission structures remain largely unchanged. Many carriers are now reconsidering how they allocate their distribution budgets, and they're asking themselves what role agents should play in the system. These new economic realities have the potential to alter the distribution landscape in personal lines and small commercial insurance. Well, let's talk about it a while. Within 5 years, says McKinsey, most personal lines and small commercial customers will interact with their agents and carriers against a full range of channels: in-person, mobile devices, by phone, internet, video conferences, technology. The carriers are going to use technology like crazy to increase their direct interaction with the primary customer. They still say it's going to get more consistent service at a lower cost. Agents are going to be compensated only for the unique value that you deliver to the customer and the carrier. Carrier management models are going to focus on resources of those agencies developing profitable, that's the big word, profitable business. And who the winners are going to be? Well, the winners are going to be agencies who deliver tailored and relevant expertise, and they'll excel at multi-channel marketing while increasing their scale and operational efficiency. McKinsey researchers then asked this vital question: is this the end of the era for the local insurance agency? How's that for a shocker? Local agents are not in danger of extinction, they say, but the role they're going to play will continue to evolve. Those who can adapt to a new set of circumstances will thrive, but carriers have got to think now about those changes and what they're going to mean for their business and begin developing robust strategies to respond. Now, here's a quick look at some history. Insurers used to compete, well, they still do, on the strength of the actuarial pricing models, right? On their ability to return a quote quickly and handle claims. But the big thing is the quality of their agency force, and that's you. Management discussions are still held on distribution. How are we going to use the agency force better? Are we going to make it easier for them to do business? Are we going to give them incentives to reward their entrepreneurial zeal? Yeah, the answer is yes. But 10 years later, that means after the early 2000s when things started happening, market forces and technological advances have complicated that arrangement. The clean division of activities between agent and carrier no longer serves carriers the way it once did, and they'll tell you that because of greater consistency they can provide, lower transactional costs, better capturing and leveraging of data, And they're taking on many of the activities that were once responsibility of agents. Agencies have a diminished role in risk selection and pricing. The old gut feeling. Remember, oh boy, he lives in the market. He really knows the local customers. Some of them he knows personally, blah, blah, blah. They used to rely on agents' judgment to improve their profitability, the companies. Today, carriers rely far less on the intuition of their agencies. They want to go think about the predictive models, the straight-through underwriting. That's diminishing the agency's roles in risk selection in both personal and commercial lines. As a sign of how much has changed, many carriers now are questioning whether the agent plays any role at all in managing profitability, especially in, you got it, personal lines auto. Well, the rise of multi-channel is coming along. Consumers expect to shop for insurance with their agent. They get claims and answers and so forth and so forth. But now with their ability to interact with their insurance provider on their own schedules, whenever they want to, through multiple channels, phone, all of those ways, they expect a consistent, satisfying experience at every interaction. The walls between the traditional distribution channels are crumbling. This is most obvious in personal auto, where recent McKinsey efforts to map the customer decision journey reveal the extent to which shoppers jump from one channel to another as they move from information gathering to purchase and beyond. Look at that. Reveal the extent to which shoppers jump from one channel to another as they move from information to purchase and beyond. Take a look at this next chart. Come back to it later on. Show the rest of the people in your agency or whatever. Really study it. Boy, this is really something. This shows at the left-hand side where they gather, what happens, what percentage of them gather it, where they gather it from, where they get quoted from, and who do they sell it, and who sells it, who do they buy it from, and that's the agent. And that's just what McKinsey was saying. Is it going to change? McKinsey thinks so. As a matter of fact, carriers are making heavy technology investments to reduce friction. They're opening central contact centers to handle questions, conduct transactions, policy changes, billings, claims, all other interactions. You know about those. Some carriers, or a lot of them, are going to replicate the feel of an agent's office. More consistency and greater ability to test new approaches. They're going to do it, and they can do it well if they are so motivated, and they will be. As more customer interactions filter through those central contact centers, the opportunities for agents to interact with the customer and add value are going to decrease. Remember, you used to say, who do you have your insurance with? Oh, I got my insurance with Joe Jones, the agent down the street, and so forth. Well, today, after 10 to 20 years during which they've invested billions of advertising dollars, building and strengthening those brands, customers are far more likely to answer the same question with the name of the carrier. It's very hard for agents to compete with this spending. And that shows on the next slide. Look at this next slide here. Look at the spending there. It's just amazing. There's marketing spent for P&C carriers on the left-hand side over there, 202 to 211. The marketing money was spent. Now it's $5.9 billion. Look at Geico, over $1 billion spending it. And look at the results. Well, that's reality, and we all kind of know that. Commoditization in personal auto, oh yeah. Consumers have an easy access now to it. They don't need an agent to navigate the carriers, explain the terms. Agents themselves, and you guys are using comparative raters, of course. Generate a number of commodity-like price quotes. The flood of price-centric marketing for auto insurance has conditioned many of our buyers to focus on price as their primary buying factor. And customer claim satisfaction is historically at high levels, leaving there's not much grounds for differentiation between insurers. What do you do? Well, the agency channel has lost 7 percentage points of share in auto insurance to direct carriers since 2003. What do you think of that? And more than half of auto insurance purchases still occur through a local agency, but in most cases, the agency is simply executing a transaction, says McKinsey. Commodity challenge, yeah, the hard truth is most agencies have neither the skill or the operational efficiency to profitably sell a commodity or even a near commodity. It's hard to do. Commission revenues and profit margins have been on a decline. Yield rates on new business remains low. Average premium per policy is relatively flat, and costs are rising due to increased operating expenses. Many agents report that auto acquisition has the thinnest margin of any line and can even be unprofitable. I've heard that a lot. When auto insurance accounting for 30 to 60% of typical agency's book, the numbers paint a difficult picture to say the least, for future profitability. Look at this chart on the next slide. Compare your rate of profitability by line to the national average. Once again, come back to it later on and take a look at it. And you can see it's 3% in auto and 3.5% homeowners, specialty lines 5%, 10% on commercial, and 50% on life. But that's pretty thin margins. And anyway, commission rates are so much under pressure. Traditional agency model says is they, being the insurers, spend little time on acquisitions. They don't have to pay for it until a policy was sold and commissions paid. We all understand that. Growth was as simple as appointing new agencies. Let's get some new agencies, you guys, in new markets. But carriers today operate in a more complex distribution landscape. Their investments got to be balanced across all of that stuff that they never had to do before. The shift is putting pressure on the level of commissions they pay to agencies. Carriers are going to need to consider rewarding agencies more directly for those efforts that uniquely add value, such as retention and cross-selling. What else is new, huh? Well, the obvious question to this: what is the future of the local agent? I'm not going to answer, but McKinsey does soon. How can the agency continue to add value and remain relevant? Those are the major questions. Now, we're going to talk about those questions, and it's going to be answered by McKinsey, or as they answer it, in the second half of today's Monday morning. Meanwhile, think of the travel agency business. Boy, they had a tough time. Travel agents really couldn't, they on the internet, they couldn't. I dropped our travel agency. If we were traveling, we go right on the internet. But travel agencies all have not disappeared. A lot of them have. There's a much lower number of them now. However, those who remain, on the whole, are larger and more successful. They reinvented their business models. Are they trying to tell us something? Are they trying to tell us that we're like travel agencies? Yeah. They shifted towards more complex travel and specialization and operational efficiency and technology. Does that sound familiar? I think so. Well, what are the implications? The second half of this webinar is going to give what McKinsey believes are the implications for agency principals in agencies large and small, and the implications and questions for carrier leadership. And this concluding presentation of our Monday morning is going to have a new twist. We're going to have a couple of terrific guys on this report. Scott Addis, president of the Addis Group and Beyond Insurance. If you don't know about Beyond Insurance, you need to. Boy, he's got a tremendous program. He's a risk manager professional. He ran a big agency, sold it, but he never left the business, and he's very, very well known, getting more so on a daily basis. Roger Sitkins, a renowned consultant. At one time, he was one of the top 2 consultants in the country. I've been working with him for probably 30 years or plus. He's now the CEO of Sitkins International. You read articles by both of these guys constantly in Rough Notes, and that's a good thing. Well, anyhow, you're going to see us all on part 2. Stay tuned. These gentlemen are going to tell you what they think of all of the results that McKinsey predicts, and it's going to be quite exciting for all of us.